We used two of the most advanced AI models to create two characters. We will put them face to face. Their arguments will be evaluated by 5 independent AI models across multiple criteria, scored from 0 to 100. This is AI Debates. Is AI overexposure becoming a systemic financial risk?
Absolutely. The financial system is increasingly exposed to AI hype. Venture capital, public equities, and even debt are tied to sky-high valuations of a handful of AI firms. When expectations outpace real revenue, any correction could ripple through markets, wiping out investor wealth and destabilizing related sectors like cloud computing, semiconductors, and startups. The concentration of risk in a few dominant players makes the system fragile. This isn't just a tech bubble, it's a potential systemic risk that could trigger broader financial shocks if reality catches up with the hype. No, AI overexposure isn't a systemic financial risk, it's a diversified boom backed by real earnings, unlike 2008's leverage-fueled crash. AI stock C. G. NVIDIA $120 billion Q3 rev drive 51% of S&P gains, but capex $342 billion hyperscaler 2025 from cash flows, not debt. Regulators monitor via FSB frameworks, spotting no contagion AI boosts TFP 1.5% by 2035. Hawkish Fed tempers hype, fostering stability. This powers $3.5 trillion growth, not fragility.
Could AI infrastructure loans become toxic if revenues don't materialize?
Absolutely. Banks and investors are pouring massive sums into AI infrastructure servers, GPS, cloud capacity based on projections that often assume near immediate revenue growth. If those revenues don't materialize, those loans could quickly turn toxic. Lenders would face defaults, firms would cut back or fail, and the ripple effects could hit suppliers, investors, and the broader financial system. This isn't hypothetical, it's a direct consequence of inflated expectations and over-leveraging in a sector where costs are skyrocketing and returns are uncertain. It's exactly the kind of chain reaction that turns a tech boom into a financial crisis. No, AI infrastructure loans won't turn toxic. Revenues are materializing fast, with hyperscalers' cash flows and long-term contracts securing the $342 billion 2025 capex. Gen-AI revenues hit $1 trillion by 2028. NVIDIA's data center sales surge 165% to $3 for T annual spend by 2030. $170 billion in new lending backed by stable leases, not speculation. Speculative private credit risks exist, but diversification via ABS and $1.5 trillion IG bonds by 2030 mitigates. This is railroads redux debt fuels enduring growth, not a bust.
Are pension funds taking excessive AI-related risks?
Yes, and that's extremely worrying. Some pension funds are pouring significant portions of their portfolios into AI startups and high-flying public companies, chasing the next big returns. These investments are highly illiquid, speculative, and tied to hype rather than fundamentals. If the AI bubble bursts, retirees' savings could take a serious hit. The stakes aren't just financial, they're societal. Pension funds are supposed to be conservative, but right now, overexposure to AI risks turning them into a vector for systemic losses. It's a classic case of chasing growth at the expense of stability. No, pension funds aren't taking excessive AI-related risks, they're cautiously allocating amid diversification and robust returns, with AI enhancing risk management. CALSTRSCIO Scott Chan flags opportunities over bubbles, targeting AI for long-term growth. 87% use AI limited to 1 to 5% of services, per SPP 20-5 survey, mostly for analytics, not bets. Funds tread carefully, leveraging AI for predictive modeling and de-risking, offsetting inflation or volatility. While concentration magnificent 7 at 36% S&P poses volatility, fiduciary duties ensure prudent exposure, yielding 1.5% TFP boost by 2035. This fortifies retirements, not endangers them.
Could an AI market correction trigger a broader recession?
Absolutely. If AI valuations collapse, it won't just hurt tech investors, it could ripple through the entire economy. Startups fail, layoffs hit, venture capital dries up, and firms dependent on AI infrastructure face losses. Combined with over-leveraged investors and pension funds, the shock could reduce consumption, tighten credit, and slow investment across multiple sectors. The hype has concentrated risk in a few key areas, and when reality catches up, it could cascade into a broader recession. This isn't just a sector correction, it has the potential to destabilize the wider economy. No, an AI market correction won't trigger a broader recession. AI's embedded productivity gains and diversified growth ensure resilience, not fragility. AI drove 1.1% of H1 2025 GDP growth, but broader TFP rises 1.5% by 2035. Penn Wharton projects 3.7% by 2075. Unlike dot-com's vaporware, AI yields real ROI. OpenAI $13 billion Rev 2025, NVIDIA 53% margins. Cathie Wood sees a reality check, not bubble burst. Fed's Waller notes divergence resolves without crash. Correction, healthy at $3.5 trillion market endures.
Are governments prepared for an AI-driven financial shock?
Honestly, no, they're not prepared. Regulators and policymakers are still catching up with the basics of AI, let alone its financial implications. There are no clear safeguards for overexposed banks, pension funds, or venture-backed startups. If the bubble bursts, monetary and fiscal tools are reactive, not preventive, and coordination across countries is minimal. A sudden AI-driven market correction could hit faster than governments can respond, amplifying economic instability. Right now, we're flying blind into uncharted territory, relying on hope rather than robust risk management. Yes, governments are increasingly prepared for AI-driven financial shocks through proactive frameworks, indices, and international coordination, mitigating risks while harnessing growth. IMF's AI Preparedness Index ranks AE's high on infrastructure regulation, projecting 1.5 to 4.3% TFP gains by 2035. U.S. Treasury's 2024 report updated 2025 tackles AI cybersecurity, with Fed integrating AI for stability oversight. EU AI Act effective 2025 classifies finance AI risks. DORA bolsters resilience. FSB OECD monitor adoption, urging AI tools for fraud. Gaps in EMs persist, but auto liquidity facilities and AI expertise build buffers ensuring stability amid $3.5 trillion boom.